Welcome, everyone. It is 12 on the dot. We're going to give folks just another minute or so to join, but we'll be starting very soon. Thanks. All right. I think we have folks that are still joining, but we have enough folks here that we're going to get started. Hi, everyone. My name is Katherine Sharpen, and I would first like to welcome you all and thank you for joining us today for NYSERDA's Insurance Innovation Prize Reinsurance Showcase. Next slide. All right, today I'm going to walk briefly through some background about NYSERDA and our related insurance work. Then we'll be hearing from 18 companies who will highlight their insurance solutions that accelerate clean transportation, building efficiency, clean energy, and energy storage technology adoption. Each company will have up to 5 minutes to pitch. We will not be having a Q&A for this session, but we'll be sharing the deck, the recording, and contact information for each company following today's event and encourage interested parties to reach out directly to the presenters. Next slide. All right, in case you don't know, NYSERDA is a public benefit corporation that works to promote an equitable energy transition and emissions reduction across New York State. As part of this great effort, NYSERDA launched a $6 billion clean energy fund, which includes an innovation and research portfolio to drive innovation and business growth in support of the energy transition. The Clean Energy Fund operates within the historic New York State Climate Leadership and Community Protection Act, otherwise known as the Climate Act. NYSERDA is deeply committed to achieving the goals set out in this Climate Act, some of which you'll see listed here. Next slide. So through our commitment and work to date, NYSERDA identified insurance availability and affordability as one of the key challenges in the energy transition. Many of the technologies necessary for the energy transition are not yet commercially available today, meaning there's limited historical performance data, which is often critical to the insurance underwriting process. To better understand this challenge, we convened government and industry stakeholders earlier this year, and we interviewed over 20 energy transition experts. From these interviews, we identified specific insurance gaps in this space, and we launched the $5 million Insurance Innovation Prize to help catalyze the development of new, innovative insurance policies and products to fill these gaps. So we received over 50 applications, and ultimately 8 were selected for awards. The winners of the award will be formally announced at the winners event that's currently scheduled for January 14th, and will be held in person in New York City. You can see more information on the Insure website for more details about that event. Next slide, please. So the Insurance Innovation Prize is a meaningful start, but there's more work for government to do in support of the estimated $2.5 trillion of new insurance coverage required for the energy transition by 2030. Government can help break down barriers, and this work will require coordination across government and industry. We invite you to get in touch if you are interested in continuing this work in the future. You'll see my emails at the bottom of the slide. You should feel free to reach out to me directly. Next slide, please. All right, now we'll get into the showcase. Next slide. So there were many more high quality applicants for the Insurance Innovation Prize than those that we could directly support. Therefore, we wanted to use our time today to showcase some of the companies doing incredible work in the insurance and energy space. Here is the list of today's presenters. We encourage you to think of this as a type of market map for the companies in this space. These companies offer insurance products and policies that span emissions mitigation and resilience, and cover technologies in the energy, transportation, and building sectors. So as mentioned, following today's event, we'll share contact information for each of the companies, and both the slides and recording will be posted on the NYSERDA website for future reference. So now, without further ado, I'll pass the mic over to our first pitch today, and we'll be hearing from New Energy Risk and EcoStrat.
Hello there. My name is George Schultz. I'm with New Energy Risk. We are managing general underwriter since 2010. We leverage our engineering expertise to unlock financing for the breakthrough technologies. We have the trust of multiple A-rated global insurance carriers to underwrite technology risks and develop bespoke insurance products that transfer technology from project funders to the insurance markets. This is enabling better bankability, balance sheet protection, and accelerating scale and financing. To date, NER has delivered in excess of $4 billion of energy transition investment. NER is a strong platform, and we have deep experience in product innovation, and we look forward to partnering with EcoStrat, given its deep experience in the biofuels feedstock analysis. The goal is to deliver feedstock supply insurance, or FSI, that will further accelerate the biofuels economy in New York State. I'm going to hand it over to our partner, Jordan Solomon at EcoStrat. Jordan?
Thank you, George. Nice to be here, everyone. Next slide, please. I want to frame up the real scope of the issue that the feedstock supply insurance that we're partnering with NER to deliver is there to deal with. Bioenergy is really a multi-billion-dollar economic problem, but there has always been a big problem with financing bioenergy, renewable chemical, or biogas plants. And that reason stems from the fact that the suppliers of the biomass are almost never investment grade. And what I mean by that is they tend to be small and medium-sized farmers and forestry companies and food waste companies, and they're almost never able to supply a long-term investment grade bankable contract. And that has a whole range of negative effects on financing bio-based plants. But in short, it means that financing is costly and it's slow. Next slide, please. Feedstock supply insurance will address exactly these issues. What feedstock supply insurance is going to do is to supply an effective cap, a long-term cap on feedstock supply costs. And that cap is designed to be unit contingent with the debt costs. So if these plants are being financed for 10-year debt costs, the insurance is designed to run also for the long term. And we expect that to have all sorts of salutary effects on the bankability of bio-based projects, both in New York State and across the United States in general, including faster financing, including lower debt costs, um, with the result being what we're all here to do, help to catalyze job creation, help to catalyze decarbonization, and do that by facilitating the construction of more biomanufacturing plants for biofuels and renewable chemicals and biogas, again, in New York State and across the country. So thank you.
Thank you. Next, we'll be hearing from KWH Analytics.
Thanks to the NYSERDA team for having me. I'm Sarat Srinivasan, Vice President, Head of Product and Strategy at KWH Analytics. I'm here to talk about DG tax credit insurance. But before we get to that, I want to tell you a little bit about KWH Analytics. Next slide, please. So renewable energy, folks on this call, know this is one of the biggest macroeconomic opportunities of the coming decade. And the statistic always surprises me, and every time I hear it, but it is expected that by the end of this decade, 40% of the electricity in the world is going to be produced from solar and wind. And as a result of that, insuring renewable energy is one of the fastest growing billion-dollar insurance segments on the market today. The challenge is that underwriting this segment requires both specialty knowledge and data. KWH Analytics is a renewable energy focused MGA, and we have both the specialty knowledge and the data. We come from the industry, and we've been around in different seats within the renewable energy industry as a team over the past decade, and we've seen it from many different angles. As an insurer, as an MGA today, we work with 5 of the top 10 global reinsurers. Our history is that we were founded as a data company back in 2012. We started out with our first product, Heliostats, which really was focused on helping investors, lenders, and tax equity investors make sense of the unstructured data that they get from their portfolio. As we built that product out, we realized that we could use the insights from the data to underwrite insurance. That's when we launched our first insurance product, the Solar Revenue Put, which guarantees the performance of a solar asset. We scaled that, and then in 2019, we published the first solar risk assessment, which now started to take a more broader look at risk management within the industry itself. And it's today on its 5th edition and is the industry's leading report on risk management and mitigation. In 2023, we launched our second insurance product, which is traditional property insurance for renewable energy. As a company, fast forward to today, we've now insured over 33 billion in renewable energy assets. So that's a little bit about us. Now, the product I'm going to talk about today is DG tax credit insurance. DG stands for distributed generation. And what you're seeing in the market over the past decade is that large projects have continued to grow very rapidly, but the pace of growth for distributed generation has been slower. There's a lot of advantages to distributed generation. It can be deployed faster, has a lower land footprint, and requires minimal upgrades to the grid, so it can really be brought to market quickly. One of the main reasons that it's not scaling as quickly is because financing renewable energy is dependent on tax credits. And to finance tax credits, you need expensive tax counsel and other advisors involved in the process. And this creates a lot of transaction costs that make it prohibitive for small projects. The Inflation Reduction Act tried to solve this problem by allowing tax credits to be sold to third parties through a transfer mechanism. But the challenge is that the underlying problem is still the same because the buyers of these credits still require tax insurance. And tax insurance is expensive for all the same reasons that financing DG was expensive. Requires expensive tax counsel and other experts involved in the process. So that's the problem we're looking to solve. Next slide, please. Our solution is affordable and streamlined tax insurance for DG. There's three key elements to our process. One is we want to offer the product as an MGA and tap into the existing insurance market. We have a lot of experience as a company raising capacity for two different products and scaling them through our distribution channels. And so that's one area of our solution. The other one is that we want to use the power of our data and technology to streamline the underwriting process. We built underwriting tools using AI and other automation approaches that have already helped our underwriters automate the process for our existing products. We're going to leverage that same technology capabilities to build new products, to build new tools for underwriting tax credit insurance. And lastly, we're going to apply a batch process versus and take that and make it into a flow process so we can have a defined underwriting box that's focused on good risks and focused on building a spread of risk that is made possible by the fact that we're focusing on smaller tax credits. KWH Analytics has deep tax credit market expertise. Our executive team has transacted on over $1 billion in tax credits in different parts of their careers over the past decade. We have a track record of doing data-driven technology to help streamline underwriting. And we also already underwrite a lot of the key elements of the risk. We underwrite the underlying performance of solar assets. We also already underwrite the risk that a renewable energy asset could be destroyed by natural catastrophe through our property insurance. And we also have all the existing carrier relationships and distribution networks. And that positions us well to launch this product and help bring more DG projects into the market, which is a key element for New York State in meeting its decarbonization goals over the next decade. And we look forward to being a part of that.
Thank you so much. All right, next we'll be hearing from Talarna.
Hi, great to be joining everyone on today's webinar. I'm Michelle Tauti, Head of Strategic Engagement at Talarna, and I will be looking at how Talarna uses insurance to de-risk large-scale decarbonisation projects and where we want to go next with our insurance solutions. Next slide, please. So as a bit of background about Talarna, we are a climate tech and finance platform for sustainable impact. We deploy our energy as a service offering in partnership with technology providers, funders, and developers. And what this is it's a subscription offering for building owners, which gives them the guaranteed availability, performance, and economic benefits of clean energy technologies without the risks, costs, and responsibilities of ownership. The mechanism that makes this possible is our investment-grade software integrated with insurance. We have a software platform that quantifies the financial outputs of projects for stakeholders and crucially quantifies the risk of underperformance for those projects. That risk quantification maps to the underwriting criteria of AmTrust Financial, a A- rated global insurer, and enables us to deliver energy performance insurance, which is a proprietary policy we co-created with AmTrust. This policy guarantees the kilowatt-hour outcomes of clean energy technology projects and what this translates to in dollars for up to 30 years. Crucially, the software and insurance combination enables us to structure energy as a service projects in such a way that building owners get day one net financial benefit from projects. At the same time, it enables funders to fully fund these initiatives because the insurance gives them the risk backstop they need and standardizes, de-risks, and scales their ESG returns. We're already proving this offering in the European market, where we're executing on 4 energy as a service deals across both the affordable housing sector, where we're currently working on a 13,000 home solar and storage project, as well as in the commercial and industrial real estate space, where we're looking to install solar panels, battery energy storage systems, EV chargers, and the like in business parks. As a result of our ability to financially incentivize the uptake of clean energy technologies, we've received the backing of ABB, $32 billion technology leader, and AmTrust Financial. We have an insurance subsidiary broker called Calclair, which is FCA regulated and authorized in the UK. And we have obtained our entity and excess and surplus lines license in New York, and are very excited to be doing more in the New York state. Next slide, please. So the insurance product we're proposing to develop is called Energy Infrastructure Insurance, and this product will protect the economic outcomes of battery energy storage systems co-located with solar panels. As many of you might know, these technologies produce a complicated revenue stack, both behind the meter and front of the meter, on which stakeholders' returns depend. What we've seen in our projects in Europe is that underpinning these cash flows, the revenue stack with investment grade long-term insurance gives stakeholders the confidence they need to decarbonize and unites all building stakeholders around a shared objective and financially rewarding goal. Based on our research with technology providers, funding partners, and commercial real estate owners, we've identified 5 key risks that are major and material to project success. And these are the risks that you will see on the screen, and they are the risks that energy infrastructure insurance will address. So firstly, shortfall indemnity. This covers the difference between the expected and delivered technology cash flows from BESS and solar. Defect and breakdown covers the repair and replacement of underperforming parts. Lack of irradiance covers periods of insufficient sunlight. Front of the meter revenue is about providing a revenue floor with an upside share on the front of the meter revenues. And lastly, we're looking to provide first and third party property risk, which covers the risk of thermal runaway for BESS technologies. A few elements of this have already been commercialized through our energy performance insurance. The other elements we are either developing with partners or are looking to integrate partner solutions to provide a holistic and dynamic policy that enables gives funders the protection they need to fully fund these offerings, and building owners the funded and insured solution they need to action decarbonisation. Ultimately, this will make energy as a service offerings more profitable and makes climate action a financial imperative for businesses. I just want to end with a quick call to action. I'm sure everyone on this call is seeing that decarbonisation and the adoption of clean energy technologies is happening at scale. However, for this to continue to accelerate, we need strong partnerships across the value chain, and there is room for everyone at the table. I very much hope that Talana will work with many of you on the call to accelerate profitable clean energy technology adoption. Thank you.
Thanks, Michelle. Next, we'll be hearing from Ariel Green.
Thanks, Catherine, and thanks to NYSERDA for including Ariel Green in this insurance showcase. My name is Jamie Daggett, and I lead the energy storage and fuel cell practice at Ariel Green. Next slide, please. Ariel Green is a clean energy insurance provider and a Lloyd's of London syndicate company. This means we directly underwrite insurance policies on Lloyd's paper and lead a Lloyd's consortium dedicated entirely to clean energy risks. That makes us AA- rated, and we can offer up to 150 million limits per risk. The type of insurance we provide is called technology performance insurance, which covers the performance of solar modules, batteries, fuel cells, electrolyzers, biofuel plants, electric vehicles, and more. Technology performance insurance differs from the more traditional property insurance, which protects against natural disasters and weather-related risks. Our team has extensive experience underwriting these types of policies and have issued over 180 policies across 30 technology types and across 5 continents as well. It includes 150 gigawatts of warranty backstops for solar modules, 5 gigawatt hours of battery storage coverage, and 1.5 gigawatts in bioconversion plants. Next slide, please. So Ariel Green typically provides two types of technology performance insurance. The first is a warranty backstop, and the second is a project output coverage. You can see from this graphic that there are multiple stakeholders and beneficiaries from technology performance insurance, including OEMs, the equipment integrators, project developers, owners, and financiers. For the warranty backstop product, Ariel Green ensures the OEM warranty, which builds confidence in the market that the supplier has a trusted warranty. The insurance also allows the manufacturer to free up capital so that they can spend more of their focus and efforts and capital on further production and development and transfer their risk and liabilities to insurance. In the worst case scenario, where the supplier goes out of business, insurance is then passed along to the buyer, the project owner, so that they can make claims directly to Ariel Green and place it directly with insurance to ensure that the project is continually maintained, even if the equipment supplier, the original equipment supplier, goes out of business. For project output coverage, Ariel Green ensures production and revenues at the project. So for a solar project, this means solar production guarantee. For energy storage, this means availability and energy capacity insurance. For a bioconversion plant, this means ensuring biofuel production rates. In all these cases, the intent of the insurance is to protect against lost revenue due to an underperforming project based on the technology underperforming. So financiers are often the beneficiary of the project output coverage because it ensures the returns or protects against debt service and makes sure that debt service payment is maintained even if the project isn't performing. So in summary, Ariel Green is dedicated to protecting the technologies that protect the environment. And if you'd like to learn more about technology performance insurance or Ariel Green, please reach out to me and I'd be happy to set up a discussion. Thank you.
Thanks, Jamie. Next, we'll be hearing from Cenerium Labs.
Good afternoon. My name is Noel Myers. I'm co-founder and CEO of Cenerium Labs, where we're working to empower the clean energy revolution with smarter, faster, and tailored insurance solutions, starting with Cenerium Shield. By way of background, I have 10 plus years of utility scale solar operations and maintenance experience across some of the largest solar fleets on the planet. And we're working to bring our expertise both in solar and in technology and software to the world of insurance. Next slide, please. For context, clean energy assets are asymmetrically impacted by natural catastrophes. And today's insurance solutions lack the information and boots on the ground expertise to get them back online quickly. The asset that you see pictured on the right here was recently damaged in Florida, hit by a tornado. This will likely take 12 to 18 months or longer to get back online, largely due to the fact that it's going to be very difficult to find the original equipment to install on that facility. As my team has moved into the world of insurance, we've identified three core problems. Traditional insurance lack critical site-specific data to inform risk assessments and underwriting. They often lack limited energy-specific technical expertise and knowledge. I have not found an adjuster that spent long time in inverters or walking fields working to fix these sites. And finally, there is often a slow and inefficient claims processing and policy payouts period leading to prolonged system downtime. This not only hurts the asset owner's bottom line, but it also jeopardizes our power grid's ability to serve our communities. Next slide, please. Our solution is working to bring Cenerium Shield to the market for smarter, faster, and tailored insurance. We directly connect to systems to collect IoT data to power our AI-powered risk engine and data analytics platform that we provide back to policyholders for condition-based monitoring and risk mitigation strategies. This then powers our proprietary risk scoring, implementing failure modes and effects analysis, which enables good stewardship credits, similar to what we're seeing in auto and healthcare and life insurance. And then finally, using parametric triggers, we facilitate fast tech-enabled claims processing and policy payouts. It's not enough to us to get cash back in the hands of our policyholders. We also offer repowering support through a network of repowering teams, think engineers, technicians, operators that do this day to day. We have our platform live and are currently going through our first pilot program connected to systems in the US, Nigeria, South Africa, and India, providing real-time data analytics, currently powering on large language models with real-time data and historical work order data. We are targeting the trillion-dollar clean energy market, starting with solar, but want to quickly move to battery, wind, hydrogen, and geothermal. And we have a novel business model in that we offer clean energy software as a service to an embedded upsell to insurance. Again, we want to make it easy to solar asset owners to identify what problems they're running into, what are most chronic for their systems, and then provide the tailored insurance that they need to cover their exact system, providing their operators the expertise that they need to get assets back online quickly before insurance might even need to pay out. And if a policy does get triggered, we want to pay out quickly and help them get back online quickly. We look forward to supporting the state of New York and the rest of the US. Thank you so much.
Thanks, Noel. Next, we'll be hearing from Exante.
Thanks, Catherine. Hi, everybody, and thank you so much for the opportunity to speak today. I'm Aidan Breen. I'm the founder and CTO of Exante. Exante is an end-to-end B2B2C parametric platform. We do all of the complicated tech bits that bring together carriers, data providers, and distribution partners to deliver innovative parametric insurance experiences. We believe parametric insurance could do much more than simply compensate for a loss. We believe it can create better outcomes, drive clean energy adoption, and empower people to thrive in a world shaped by climate change. Helping people evacuate or prepare for hurricanes ahead of time using wind forecast triggers, helping farmers survive drought, poor weather at harvest, frost or blight with real-time weather triggers, improving travel experience with weather at destination cover or flight delay cover, or full reimbursement for concert cancellations. There's a whole world of possibilities. But I'm here today to talk to you about our flagship product, a product that will greatly impact the transition to net zero by increasing solar adoption across the board. We call it the Sunshine Guarantee. Next slide, please. So solar installers have a very high customer acquisition cost for residential and SME solar. This is partly because solar prospects are cynical that the proposition is as good as the installer is suggesting. One of the leading sources of doubt is their annual irradiation projections, which they believe are exaggerated. And the solar installers have an incentive to exaggerate that. Of course, they want to sell you solar panels. They're going to tell you that you get a lot more sun than you do, and they're going to pay you more than you expect. And in reality, nobody really thinks it's as sunny as it really is. But as it turns out, solar irradiation is much more consistent and steady than most people expect. The Sunshine Guarantee is a parametric insurance product. Our tool predicts the local annual solar irradiation volume at that site, and it guarantees it. Every solar site, or if the solar site gets less than the expected amount of irradiation, we automatically refund the owner the difference. We have a phrase here in Ireland, make hay while the sun shines. It means to take your opportunities when they come. With the Sunshine Guarantee, if it's a good year, you save more on your energy bills. If it's a bad year, we make you whole. It's a product that helps you make hay even when the sun isn't shining. Next slide, please. Okay, so solar installers' sales cycles are very complex. Individual homes must be modeled and quoted. Different combinations of panels, inverters, and batteries must be considered. There's a lot of options. It's a lot of work. It takes time and it costs money. Typically, a solar installer can expect to convert around 1 in 4 leads. In this industry, customer acquisition costs are quite high, with individual leads ultimately costing hundreds of dollars. With Sunshine Guarantee, installers convert 1 in 3 leads, greatly reducing acquisition costs. These are not customers that they've won from their competitors. These are customers who would not otherwise purchase solar panels. Sunshine Guarantee pays out annually for 3 years. Each payout is a touch point with the customer that provides an option to cross-sell or upsell additional services. And Sunshine Guarantee is live in Italy. We have hundreds of policies right now. We're monitoring them all across the country. And we are very quickly moving into new markets. We've got a massive 2025 planned ahead of us, both across Europe and into the US. And we're really, really excited to see where we can bring this product and how we can better drive the transition to net zero and encourage clean energy adoption. That's everything I have today. So thank you so much for your time. I very much appreciate it. And looking forward to hearing from anybody if you have any questions.
Thank you for that. All right, next we'll be hearing from Energetic Capital.
Hi, folks. Thanks for having us today. You've got Nathan Maggiato and Steve Verity from Energetic Capital. Next slide, please. Energetic is a distributed energy resource focused MGA that de-risks project financing in order to bring more lenders, investors, and capital into the distributed energy resource space. We got our start as a credit insurance MGA, writing a policy that covered payment under long-term PPAs, ESAs, and other relevant contracts. To date, our policy, we've got over 300 million in policies supporting more than $550 million in total project value. We're backed by SCOR, which is the 5th largest reinsurer in the world, based in France, with equity investments from SCOR and leading global insurer Anis Amlin. We are very tapped into the distributed generation, distributed energy resource space, and one of the problems that consistently arises is with securing tax equity. We see this as a vicious cycle that really stems from insurance. The developers, platform operators, and other stakeholders are all saying the same thing, that the small and medium projects that are most impactful to the communities in which they install are difficult to insure because they cannot bear the minimum premium and underwriting costs associated with these transactions, which means they can't secure tax equity or tax transferability investment commitments. They can't secure commercial financing to bridge and finish their construction. They can't progress their projects, and they're forced to abandon their projects, sell them to somebody else, and lose out on the opportunity for their own individual value creation. So we have devised a new way to consider insuring renewable energy tax credits that focuses on 3 core innovations in policy structure, distribution channels, and underwriting approaches. And with that, I'll turn it over to Steve in the next slide.
So I'm Steve Verity. I'm the lead underwriter here at Energetic and head of their transaction liability practice, as opposed to Nathan and the balance of my team here at Energetic, which has more of a background as on the insurance side. I spent the past 15 to 16 years at Novogradic, where I was one of the leads in their transaction advisory and project finance practice. As I think Nathan alluded to, as many of people on the call likely know, one of the main sources of capital for these renewable energy projects is tax equity proceeds. And I've been doing these deals for the past, like I said, 15, 16 years, everything from residential portfolios, C&I portfolios, utility scale transactions. I think one thing that almost all of these transactions had in common was the fact that they are typically in excess of $20 million and more often than not in excess of $50 to $100 million, simply because it's these size projects that can support the transaction costs that come along with a traditional tax equity financing on both the insurance side and on the simply transaction cost side. This unfortunately leaves out a large pool of small and mid-sized C&I projects, which ultimately changed a little bit with the Inflation Reduction Act. Now, instead of needing a traditional tax equity partner, a developer can now sell a tax credit to an unrelated party. At the outset, I think this seemed like a win and a good solution for the industry because it would give these small project developers an alternative to the traditional tax equity proceeds. But in having some discussions with many of my former clients at Novogradic, they indicated that although the transfer provided a new way to monetize the credit, many of these transferee partners were still requiring tax insurance to cover either basis, structure, or the recapture risk that might be associated with the credit. And while there were products available, again, because of the size of these projects, they typically were not able to support the minimum premiums and minimum brokerage fees that came along with them. So it was at this time I started to talk with the guys at Energetic, and we started to analyze more of an embedded insurance solution, which would allow for an insurance product to be offered to smaller projects based on a set of predefined parameters and embedded at either the point of sale of the credit, or even better, embedded at the point the project was actually listed on a transfer platform or some form of credit exchange. This master framework and an endorsement methodology would effectively allow us to drive efficiencies, allowing for a higher volume of transactions to be analyzed, and would be further supported by the design and deployment of advanced large language models to further help efficiently filter out some of those ineligible submissions. At the end of the day, our goal is ultimately to provide cheaper and easier access to tax credit insurance to some of these small project developers, which will ultimately result in more certainty in the underlying credit being claimed and more availability of those tax credit or transferee partner proceeds. As you can see on this side, we have identified a few potential partners, but are still seeking iteration partners with others in the industry that are experiencing some of these same challenges. For additional information, you can reach out to myself or Nathan. But aside from that, thank you for your time today.
Thank you both. All right, next up, we'll hear from Luminar.
Hi, everyone. I'm Seth Simon, Chief Claims Officer for Luminar Insurance Services. Luminar manufactures LiDAR vehicle safety systems, which we'll learn a little bit more about on this call. If we can go to the first slide. Our new insurance program deals with a problem that I think we can all commiserate with, rising auto insurance rates. In fact, my rates in New Jersey were raised 33% this year. That's 33% by my carrier for all customers, whether or not you've ever had a claim or an accident. That's in New Jersey. We know that across the river in New York, New Yorkers pay the highest auto insurance rates in the entire country. Why are these rates continually rising? We know that the main factors are vehicle repair costs and fraudulent claims. Insurance companies haven't been able to solve for these factors. The only solution that's been put forward year after year is to raise rates. Even though our vehicles today have more tech, that hasn't translated into lower claims costs. We've actually seen increased material costs on EVs when there are accidents, parts shortages, and longer repair wait times. Our insurance solution centers around the tech that we build here at Luminar. What is LiDAR? LiDAR stands for Light Detection and Ranging. These safety systems use lasers which shoot out onto the roadway in front of the vehicle. They shoot out 3 times as far as the cameras in vehicles today can see. LiDAR produces instant 3D maps, and it doesn't require the processing that camera data requires. These LiDAR sensors tie into the car's advanced driver assistance systems to stop cars quicker or to take other evasive maneuvers. In short, LiDAR-equipped vehicles will prevent accidents from happening, not just reduce the amount of accidents. Here's a little bit more about Luminar. We're a global public company. We have plants in the US, Mexico, and China, and we build our LiDAR sensors from the chip level up. This allows us to control reliability and price. Our sensors will be on production Volvos and Mercedes models, and we work with 75 other OEM brands. The company vision for Luminar is to eradicate vehicle accidents, to save 100 million lives, and to give back 100 trillion hours over the next 100 years. If we can go to the next slide. So let me explain a little bit about our insurance thesis and product. We explained what LiDAR is and how it produces a greater safety effect than today's camera-based vehicle systems. We've actually been able to quantify the effect of our product. Swiss Re recently published some independent testing, and that testing reported accident frequency improvement of 27% and accident severity improvement of 40% for vehicles equipped with Luminar LiDAR when tested against the safest other vehicles out there available in the marketplace. So here's our proposition. Safer cars deserve lower insurance rates. How are we going to deliver this? We're currently filing an admitted auto insurance product with deep discounts for LiDAR-equipped vehicles. We see this as helping to lower the cost of EV ownership and also helping to promote EV sales. We formed an MGA, Luminar Insurance Services, to sell this product, and we formed our own captive to provide capital for this program. In short, we're building the entire infrastructure necessary to deliver the first product with discounts for this type of tech in the United States marketplace. And New York will be one of our first launch states. So we'd love to speak with anyone interested in partnering on our program, and we appreciate your time today.
Thank you, Seth. All right, next up, we'll be hearing from EV Star.
Hello, I'm Ted with EV Star. EV Star is the first of its kind to offer underwritten warranty protection designed to protect electric vehicle charging stations and other zero-emission fuel technologies when they fail under warranty and ensure timely repairs occur without any risk of out-of-pocket costs to stakeholders. The problem to date has been that electric vehicle charging stations are broken and they're not available when needed because the price of repair, even when under warranty, is costly, and arranging on-site technical support is tedious and time-consuming. A recent J.D. Powers press release dated August 14, 2024 reports a challenge remains to EV adoption because mission-critical EV chargers are found to be out of service, unavailable, or broken. 19% of all EV drivers said they visited a charger but were unable to charge their vehicle because the charger was out of service or just wouldn't work, with damage to the cable or connector as a notable reason for a non-charge result. New York has the second largest number of EV charging stations, 3,787 as of April 2024. If 19% of New York's EV charging stations are not operational, this means that 719 chargers are affected. EV Star removes the traditional technical and financial barriers to timely EV charging station repairs by creating, offering, and administering comprehensive warranty products underwritten by AIG General Insurance Company that can be sold with EV charging stations by manufacturers and resellers. EV Star's warranty products are legally compliant, regulated, and have been filed and approved by the Department of Insurance in all 50 states and the District of Columbia. An EV charging station that is protected with an EV Star underwritten extended warranty policy is protected against out-of-pocket costs when an EV charging station fails due to mechanical, electrical, power surge, or accidental damage and handling event. Underwriting enhances the value and appeal for both the customer and the company offering the warranty. Effective underwriting allows organizations selling EV charging station warranties to manage risk exposure at a fair price per premium while ensuring customers receive superior protection for their purchases. In this instance, AIG Warranty Guard provides insurance which backs the financial obligations of the EV Star extended warranty programs. EV charging station manufacturers and value-added resellers can now offload their warranty reserves, transfer the risk to AIG, and achieve balance sheet relief through fixed price policies. This removes the need to hold a claims reserve beyond the acquisition of the policy and protects the customer against out-of-pocket expenses. EV Star offers OEM, 3-year, and 5-year underwritten warranty terms. By offering AIG warranty protection on every electric vehicle charging sales quote, sellers can now define revenue at time of sale, remove claim risk, and offer customers superior warranty protection for their electric vehicle charging stations. This allows the seller to profit immediately without the need to hold reserves at time of extended warranty, ensures a warranty program that is compliant with legal and regulatory requirements in all 50 states, wrap the underwritten insurance protection around the OEM warranty, offer superior underwritten warranty protection, and deliver a less than 72-hour on-site response Monday through Friday. The EV Star warranty provides additional customer benefits, including peace of mind and confidence in AIG underwriting. Knowing that a reputable insurance company backs the extended warranty provides customers with increased confidence in their purchase and assurance that they're protected. Financial protection. This underwritten warranty acts as a safety net, shielding customers from potentially high repair or replacement costs that may arise after the original manufacturer warranty expires. Enhanced product value. The availability of an underwritten extended warranty that can offer additional coverage protection makes a product much more attractive, increases its value, and potentially influences a customer's purchasing decision. Next slide, please. When a warranty issue arises, the EV Star portal is used to create a claim that is viewable by EV Star, the reseller, the service provider, and the customer by product serial number. All activities can be viewed on the portal and all parties can follow the fulfillment of the claim. EV Star is the administrator who assigns the claim to an approved service provider, and EV Star maintains a network of top-tier providers in all 50 states and District of Columbia who stock inventories of parts, have electricians and certified technicians who can arrive on site within 72 hours of a claim's approval to initiate repairs. By removing the financial risk of warranty claims with underwriting and offering improved terms and conditions, this solution is sufficiently different from products that exist and offer a strong and durable competitive advantage. EV Star is actively seeking reseller partnerships with organizations interested in selling extended warranties with EV charging stations. For more information regarding EV Star, please contact me directly at tmanser@evstar.com. And thank you, NYSERDA, for this opportunity.
Thank you, Ted. All right, next we'll be hearing from Stable Auto.
Thank you, Catherine. Thanks so much, everybody. Good morning, good afternoon. My name is Rohan Puri. I'm the co-founder and CEO of Stable, and excited to talk to you today about what it looks like to be able to establish a predictable utilization baseline for EV charging station utilization, and specifically public EV charging stations. Next slide. So what is Stable? Stable provides AI-based software to help de-risk EV charging deployment. What does that mean? We essentially provide analytics and models that are able to accurately predict what the demand for an EV charging station will be. With these demand prediction tools, we're able to provide site selection services as well as real-time pricing management. And we're by far and away the leading software for placing and pricing EV charging stations across the country. In fact, today we are already the underwriter-approved solution for financing EV charging infrastructure, given the high accuracy of which we can predict what the utilization of a public charging station will be. Some of our customers include Emanate Energy, Mercedes-Benz, National Grid, Generate Capital, Florida Power and Light, oil and gas companies, auto OEMs. Anyone who is taking financing risk on EV charging station utilization is already using Stable today. Now, what do we plan to do with this? Well, the next step, next evolution of this is if EV charging utilization is predictable, which we've been able to prove pretty convincingly after operating this company for so many years, you can then ensure a baseline utilization rate on that EV charge utilization. In fact, we've been doing this for long enough that we know our utilization is correct within plus or minus 2% of the observed utilization rates with 93% confidence. And you can make public charger utilization look a lot like fleet charging if you're able to predict demand at a charging station correctly, which gives, of course, companies who are financing and deploying EV charging infrastructure some assurances about the performance of their assets before they deploy. So let's talk a little bit of how this works. Next slide, please. So Stable provides demand forecasting, were used for underwriting and ensuring public EV charging station deployments. The underpinning of all this is a massive treasure trove of data. We have ground truth EV charger utilization data from 47,000 operating chargers across the country, going back over 4 years. So we've actually been able to track and monitor utilization rates of these chargers and understand how they've gone up or down based on things like EV penetration rates, the deployment of competition nearby, and reviewed updated EV penetration forecasts. We've then correlated the utilization of these chargers with 75 other geospatial features, looking at traffic, demographics, points of interest nearby, major roadways, to help understand what is generally correlated with stronger or poorer performing EV charging station locations. Today, this is the largest ground truth data set that exists in the United States, and it gives us confidence in the deployment and the baseline performance of charging station utilization rates, which have improved about 50% in the last year alone. So how does this work? Essentially, customers can put in an address for a prospective EV charging site or an existing site, the number of chargers they're looking to deploy. We can predict and forecast what the utilization, kilowatt hour energy will be, associated energy costs, and of course, getting it all back down to ROI. So what is Stable trying to do? With this massive data set and proven models in the deployment of EV charging utilization, along with trusted references and referrals from customers that we've already been operating with so far today, we believe now is time to introduce first of its kind EV charger utilization guarantee for public EV charging stations. This didn't used to exist. It doesn't exist today, but only exists where we see fleet charging. We think it is very clearly provable that the demand for charging stations is predictable today. We're looking to work with partners in the deployment of this new category of insurance, a type of insurance that we see in many other categories of clean energy assets today. There's no reason this can't exist for EV charging utilization for public EV chargers today as well. It's just a matter of who gets there first. So thank you so much. Again, my name is Rohan Puri. I'm the co-founder and CEO of Stable Auto. I look forward to working with a few of you. Thank you.
Thanks, Rohan. All right, next up is WorldSpan.
Hi, everybody. Good afternoon. Thank you, first of all, to NYSERDA for putting this on. It's very generous of you guys. Name of our company is WorldSpan. Next slide. My name is Janak Patel. I'm the CEO founder, and I'm here along with my co-founder, Lindeen Patton, who is a former Chief Climate Product Officer for Zurich Insurance and former outside counsel for Tesla. The story of WorldSpan really starts in my previous life as a commercial real estate investor, owner, and hospitality developer with brands underneath Marriott, IHG, and Hilton. And so my last project was really a passion project of turning around a historic boutique hotel built in 1928. And wonderful hotel, great story in background. But as you can imagine, with a hotel built in 1928, it was horribly energy and water inefficient. And so with that, I started to look around to see what was out there as far as options to finance such improvements. And I didn't find too many things out there, but I did come across one. And this program is called PACE, Property Assessed Clean Energy. That's what that stands for. When I first came across it, I thought, wow, this is God's gift to business owners. It's 100% financing, low rates, long-term, and it could be used to finance a whole host of improved energy efficiency improvements, as well as water efficiency, resiliency, and renewable improvements, as the ones listed here. With that, I applied, I got approved, but then I hit a major bottleneck that currently exists in the program, and that I came to find out affects 7 out of 10 applicants. And that bottleneck is that banks do not like this. My senior lender rejected me from obtaining this financing. And I started to ask questions. I started to look at the data. I started to ask why. And what I found was there's a huge delta between actual risk and perceived risk in this financing program that to date had 0 defaults. And so that inspired me to connect with experts like Lindeen, and we started to work on this idea. And we decided to create WorldSpan to essentially create an insurance product to bypass this bottleneck and to open up the floodgates of green financing. And so that is our company in a nutshell. I'm happy after our presentation to share with you some of our materials as far as policy, underwriting, actuarial studies. We currently have an A-rated fronting carrier, and we are open to partnerships with other capacity, as well as just open to other distribution partnerships. And so that is our presentation for today. Thank you so much for your time, and we look forward to connecting.
Thank you so much for that. All right, next we will be hearing from Oka.
Thanks, and great to meet you all today. Chris Slater, founder and CEO here at Oka, a carbon insurance company. My background, 25 years in the insurance market. I built a business called Simply Business that spanned both the UK and the US, delivering small business commercial insurance, and sold that to Travelers in 2017 for $500 million. And then got involved in climate in the sort of 2021, 2022. And saw a huge opportunity in the carbon markets to try and bring risk solutions to help the market scale. Next slide, please. So really the problem what we're trying to solve is that the carbon markets, both on the voluntary and compliance side, have been around for about 20 years. But certainly on the voluntary side, face an identity crisis. They lack regulation, they lack transparency. If you're a project developer working on reforestation, in biochar, in direct air capture, looking to sell credits through the voluntary and compliance market, the challenge is that many of the risks that exist around those projects are often borne by the developers. So what we identified was an opportunity to try and help developers really de-risk either contracts by selling those credits to corporates, or indeed raising capital and trying to fund projects as they look to either avoid or sequester carbon from the atmosphere. And how we do that is we built a Lloyd's syndicate here in the UK with an agency in the US that effectively gives me the opportunity to manufacture these new products, put them into market, work closely with developers to really understand the risk, and then really take that risk off their balance sheet and onto an insurance balance sheet and enable transactions to be made much more confidently. Ultimately, that unlocks buyer demand. We start to see increased investor confidence and increasing access to capital for developers and the very best developers to help them scale. Next slide, please. One of the products that we've launched, one of a number at the beginning of January this year, is one aimed very clearly at the airline market, and a very specific problem that has emerged there is that airlines have come together in a quasi-compliant scheme called CORSIA to effectively decarbonize, and they're going to estimate to demand 100 million to 200 million credits over the next number of years. But the industry is concerned by a very specific risk, one around jurisdictional risk. What happens if you as a developer selling credits out of a country, the host country decides to claim those credits for themselves? We worked closely with the developer, a Rwandan cook stove developer, to identify that this double counting risk, effectively this risk of the country using the credit as well as a private enterprise, is a risk that needed to be dealt with for airlines to be able to buy confidently. And therefore we built a product specifically to cover for that risk. So what we've done is effectively taken a very standard political risk contract frustration product off the shelf from the market and brought our carbon market expertise in and delivered this product, and excited about how that is going to help unlock transactions for airlines in the future, and one of a number of products that we're looking to scale as we go into 2025. We've had some great traction. We launched the business last January, funded, and then came to market with our licensed products as of the 1st of January, and just closed our first $1 million revenue with a number of key customers across the world, key developers looking to use our products to help bring more confidence to those transactions. So yeah, welcome any follow-up after the session, and thanks for having us on.
Thank you, Chris. All right, next up we'll be hearing from CIC Specialty.
Great. Hi, thank you for having me. It's an honor to be part of this group of presenters. My name is Sarah Kane. I lead you can go to the next slide. Thank you. I lead the power and renewables practice at CIC Group. CAC is one of the fastest growing insurance brokers in the US, and my team specializes in insurance and risk management advice for power generation project owners. We created Cirrus Advisors 3 years ago in response to a need we saw in the market for insurance advice provided separately from insurance placement services. As the insurance market was going through a period of change, property insurance in particular, annual insurance costs for energy projects were both, one, difficult to forecast with reasonable certainty, and two, increasingly important to the overall financing package. Cirrus helps the renewable energy industry design, build, budget, and finance projects with insurability in mind at the front end, even though an actual insurance purchase might be years down the line from initial project development activities. We currently provide our insurability advice to wind, solar, and battery energy storage projects where we have clear line of sight to ensure appetite on site selection, equipment choice, and design, which are the 3 key elements that inform their underwriting. We're able to do this by using the intelligence we get on today's wind, solar, and BESS projects to help guide the development of the projects that will be ready to buy insurance in a few years' time. We typically provide this advice through an insurability report, providing real actionable guidance to the developer that will impact future insurance purchases. Cirrus helps the developers be clear on what a financeable package of insurance will cost, so there are no unpleasant surprises when it's too late to make meaningful changes. Now, how does this apply to the energy transition more broadly, where we are looking to ensure exciting and first-of-its-kind technologies and can't predict with reasonable certainty how multiple potential insurers will respond? It's pivotal to have insurers connect with early-stage project developers to provide their risk engineering advice directly. 2 recent reports from the Geneva Association make a clear and compelling argument for such involvement and further propose a framework that can be used to address future insurability and help bring projects out of pre-commercialization. The challenge, though, is that there are meaningful structural challenges that make establishing this connection difficult, if not impossible. As depicted in the center of the slide here, while developers take advice from a myriad of stakeholders, they're not connected to insurers, and the barriers to doing so are twofold. First of all, how does a project developer access the right expertise within an insurance company? The key engineer or underwriter who understands a specific technology, if such a person even exists within an organization, is not going to be obvious from the outside. Secondly, how does an insurer access project developers, and what is their revenue incentive for early stage interactions? Insurers are generally not set up to find their insureds directly without broker involvement, nor do they have an incentive to spend meaningful time providing advice now when the project may or may not make it to market and may or may not choose to partner with this particular insurer when it's ready to buy insurance. So Cirrus addresses these challenges with the innovation we are proposing today. Next slide, please. The key is to make sure that insurability advice we provide today is tied to a real insurance quote in the future. To do this, we propose starting a managing general agent, or MGA, focused on early stage energy project developers working to commercialize new technologies. It will be capitalized with the expectation that consulting revenue is near term, while underwriting revenue comes later in the later years as projects mature. It will focus on property insurance at the outset, with additional products added as and when the need arises. The nature of an MGA is such that it can pool capacity from multiple property underwriters. This helps individual insurers take smaller positions on newer technologies, and then it helps the insurance market more broadly by providing an efficient way to spread risk. Importantly, it also ensures that we have a broad range of underwriting opinions represented on any given project. Cirrus will continue to offer our insurability reports, but now they will be written by the in-house underwriter with input from multiple insurers. This is a key enhancement from our current offering, which necessarily relies on using insurers' current behaviors to give us insight on how they will treat similar projects in the future. For newer technologies, we just simply do not have this information. So finally, when projects are ready to buy insurance years later, the MGA will offer a premium credit to projects to which they have provided consulting services, keeping the entities tied together. This relatively simple change to the status quo addresses a number of problems. First, it creates a pathway and an incentive for project developers to engage with the insurance market, solving the access problem. It allows insurers a cost-effective way to provide their input to projects without investing in a distribution network, again, addressing the access problem. It creates a pathway for insurers to earn immediate revenue for their advice while positioning themselves for the future underwriting revenue, which gets at the incentive problem. It removes the need for early involvement from insurance brokers who do not have the correct incentives themselves to engage in very early stage projects, but nevertheless have been the key bridge for developers to insurers up until this point, again, addressing access. And it provides projects with clear guidance from a range of insurers that can be used to facilitate financing discussions, recognizing that there is currently a bit of a chicken and egg problem in raising early stage capital for projects and technologies that don't have clear line of sight to insurability. Of note, our innovation is not a new insurance product or technology. Rather, we're trying to address key structural challenges that inhibit getting the most basic and required of insurance policies, that being property insurance, deployed efficiently to new technologies. SEERS can provide the correct incentives to all stakeholders to move insurance guidance up in time so that it can be used to build more resilient projects and commercialize exciting new technologies. We're seeking capital to accelerate bringing this solution to market. Thank you so much for your time and attention.
Thank you for that. Okay, next up we'll be hearing from Rick in InsurTech New York.
Hi, I'm Nikita Devlin, CEO and founder of RIC. At RIC, we specialize in climate-focused parametric insurance products. For those of you new to the term, parametric insurance works simply. If a predefined event occurs, policyholders receive a prompt, pre-agreed payment. No hassle, no delay. Our expertise lies in developing affordable, consumer-friendly products that also meet the needs of larger stakeholders. For example, in our collaboration with the government in a coastal city in Virginia, we tailored the activation triggers of our rainfall flood policies to address severe weather events that impacted the entire community. This strategy not only provides affordable coverage for homeowners and renters, but also supports the municipality by increasing insurance uptake in the community for events that impact the municipality. Helping the municipality maintain its bond credit rating, it's a win-win solution for all parties involved. We see a promising opportunity to apply this model to the utility sector as we develop our extreme heat product. Next slide, please. As climate change continues, we're seeing more frequent and severe heat waves, which dramatically increase energy demand and utility costs. This not only strains our wallets, but also poses serious health risks, particularly for vulnerable populations. During these events, the demand can push our electrical grid to the brink, raising the risk of blackouts and system failures. Plus, we end up relying more on peaker plants, which are not only costly to us, but also to the environment. If we don't address these emissions, the environmental and health-related costs for New York City could soar over $1 billion by 2035. On a positive side, we know smart thermostats offer a promising solution. By increasing smart thermostat usage with demand response programs, we can take the equivalent of a peaker plant offline. Next slide, please. Our parametric extreme heat product is designed with simplicity and effectiveness in mind. It operates based on a parametric index, like temperature spikes or grid stress levels, triggering a payout when certain conditions are met. Leveraging existing consumer programs, this product would be accessible to anyone who has installed or decides to install a smart thermostat and participate in a demand response program. For less than $10 a month, customers gain peace of mind with a potential payout ranging from $500 to $1,000, providing substantial financial relief during critical times when it's most needed. We've partnered with InsurTech New York, who are tech experts and conveners in the insurance space, to develop this product. And we hope to find more partners today within the energy sector to help us refine the product framework. Thank you for your time, and please reach out if you want to learn more.
Thank you, Nikita. Okay, next up we'll be hearing from Salient Predictions.
Hello, everyone. Thanks for having us. I am Laura Fieselman, VP of Operations at Salient Predictions. The challenge that we are tackling is climate-driven weather volatility. We're a weather forecasting company looking at long-range weather forecasts. And we all know that that increase in weather volatility is an expensive problem and at times a socially catastrophic one. The reason that we exist is to help organizations profit using advanced long-range weather analytics. Next slide, please. There's a step change happening in what is possible with weather forecasting right now. If you all have been watching the news, AI and machine learning are unlocking both higher levels of accuracy and longer lead times in terms of what is possible with weather forecasting. And Salient is native to this step change in what is happening. We're an ML machine learning native company founded in 2019. And the subseasonal to seasonal, or S2S, as we call it in the weather industry, lead time is the core of our forecasting focus. So we're providing forecasts day ahead out to a full year ahead. The theory behind the company is that oceans govern what happens with the weather on longer lead times because oceans hold the bulk of the heat and the water on the planet. The company is actually founded by an oceanographer, Dr. Ray Schmidt, whose original hypothesis was that we can correlate ocean salinity with precipitation, because where the ocean is saltier than normal, that's because a bunch of water has evaporated that's going to come down later somewhere else. He built an initial ML model that correlates salinity and precipitation, entered the US Bureau of Reclamation forecasting rodeo, delivered a preset forecast week on week for a year, won the prize, took the prize money, hired the person that won in the temperature category, and started the company. And our modeling approach has evolved a lot since then, but the core theory stands, which is that oceans govern what happens with the weather. In the longer lead time, you can see that graph in the bottom row in the center there. And then as we get closer to now land-based variables and then atmospheric-based variables govern. So that's how we're doing what we're doing, integrating a whole lot of data across ocean, land, and atmospheric variables into our model and using teleconnections to find patterns across those. We are about 17 people between a seed and a Series A, very rigorous science company. We are tackling a tough problem here and hold science core to how we operate. Next slide, please. Our product is weather forecast data, weekly, monthly, and quarterly forecasts. We're providing probabilistic distributions, and data sets include both forecasts and hindcasts, which enable our customers to do back testing, along with agriculture and energy data sets and a risk insights and custom thresholding tool. I will say, relevant to those of you in the insurance industry, we are not forecasting perils, but rather traditional meteorological variables like temperature, precipitation, solar, and wind, a handful of variables relevant to the energy industry like heating degree days and cooling degree days, and then a number of derived variables as well. It's an API first product with a web viewer available, which is the screenshot that's there on the screen. And I will say that energy and agriculture are the primary sectors that we serve, alongside insurance as well. And the insurance use cases are some of those that we've heard today. Salient is not an insurance product, but rather using our data to inform and help insurance companies and insurance products capture additional value. Insurers are using us to price risk, make participation decisions, build new products, and provide good customer service. And there's a handful of use cases that I want to call out. Loss avoidance communication, parametric insurance, both across a single meteorological variable and covariant variables. So when is it likely to be hot and dry, for example? Weather risk hedges, particularly in reinsurance space for energy and soft commodities, sport and leisure event cancellation, crop insurance abroad, and crop fund designation here in the US, snow protection, both on the removal side and on the ski resort side, revenue hedges for solar generation, wind, etc. I've included here a handful of logos that I can disclose publicly. Munich Re Ventures is an investor, Zurich is a customer, and also call out that we have some nice R&D partnerships with NOAA, NSF, and the Bill and Melinda Gates Foundation. Please reach out if you are curious about how advanced long-range weather analytics could support the insurance work that you're doing. Again, I'm Laura Fieselman with Salient Predictions. Thank you.
Thank you, Laura. Next up, we have Adaptive Insurance.
Awesome. Hey, everybody. I'm Mike Gula, CEO and co-founder of Adaptive Insurance. It's great to be here. And a big thanks to our hosts for inviting us today. Adaptive insurance is helping businesses build financial resilience against losses due to climate and weather events. And we're starting with our suite of parametric insurance products. Everybody here knows how climate events are increasing in frequency and cost. Businesses are now suffering over $1 billion from natural and climate-related disasters every 3 weeks. What many of us here may not know is that about 40% of all these losses are not covered by traditional insurance. And these gaps in coverage are growing, and businesses are being the ones left paying the price. This is where we feel that parametric insurance comes in. Parametric insurance is a one-time policy that pays out a set amount of coverage when a specific event occurs. And I'll give you an example using Adaptive's first product, which we call Grid Protect, which is a parametric insurance product that covers businesses for short duration power outages. Imagine you own a restaurant and you know that a power outage over 12 hours is going to cause you to lose a day's revenue. Let's say that's $20,000. That's the coverage amount that you'll then purchase. Then when the power goes out, Adaptive verifies that it was 12 hours or longer through our third-party data sources, and then we pay you the $20,000. And because the claim is an automated process, Adaptive can pay you in 2 to 4 days, getting you capital in your hands when you need it the most. But let's take a step back for a moment. Why is now right for parametric products? Parametric products have been around for a long time, but here's a number of points on why Adaptive's entry is perfect timing. First, the tech and data are now at a place where we can really take advantage of them in a way we couldn't before. I think that's evident from a lot of the companies that we've heard here today, especially with the way that we can utilize AI and making data optimization so much more sophisticated and scalable and efficient than ever before. Second, there's a collision, right? I already mentioned the increasing frequency and cost of climate events colliding with the increasing gaps left by traditional insurance, leaving businesses increasingly empty-handed with no recourse except to pay out of pocket. There's no other options for small and medium-sized businesses to cover these gaps. And last, we actually interviewed customers and agents, and they want this type of product. We conducted a customer survey that showed over 70% of business owners were willing or very willing to buy a power outage policy, even if it meant extra premium. We also conducted an agent survey that showed 76% of agents are motivated to highly motivated to sell parametric insurance. Next slide, please. So in addition to building out a suite of parametric solutions, we're also building Omnia, which is the name we finally call our AI platform. We're using it to create a climate resiliency marketplace. By optimizing data and building partnerships, we can deliver solutions to businesses that goes beyond insurance. I'll give you another example. So you've decided to open a new restaurant in a different state. You can use Adaptive's predictive data to find out about any climate impacts, what will happen in the next 5 to 10 years. With that data, you can purchase additional insurance should you need it or not. You can choose to take proactive measures like installing an elevated HVAC system or a backup generator, which you can purchase from one of Adaptive's embedded partners on our platform and potentially qualify for a rebate. Now apply that scenario to any number of different businesses. Grid Protect, which is our first product, will launch this January in 6 states, including New York State, and will also be in 25 states by the end of the year. We're looking to launch 3 additional parametric products in the next year while we build out the foundation for our marketplace. Initially, we're offering our parametric solutions to small and medium-sized businesses through insurance agencies and aggregators who still sell roughly 80% of commercial policies in the US. So why is Adaptive the company that will bring this to fruition? All of our parametric products are designed to be simple and elegant, intended to help our customers in the moment that they need it. Our products are also what we view as very necessary. We see a demand on both a macro and a micro level. And I'm proud to say that we have an amazing team at Adaptive. We've all worked together in previous startups, and we've combined have over 40 years of industry experience. And lastly, I'll just say that we passionately believe in what it is that we're doing. So I'm going to wrap up and just thank everybody here for the opportunity to share what we're building here at Adaptive. You're welcome to visit our website at adaptiveinsurance.com for more information. Feel free to contact me directly or our team, and we look forward to hopefully working with some of you. Thanks so much.
Thank you, Mike. All right, next up we have Eventual.
Thanks, Catherine, and good afternoon, everyone. Next slide, please. My name is Dylan DeMarchi. I'm a former Blackstone real estate investment professional, and now I lead our team at Eventual in New York. We are the company behind the Premium Lock. We originate new financial contracts and products that improve multi-year affordability and financial predictability for real estate owners facing the ongoing property insurance crisis, which is a climate problem. With Eventual, you type in an address and we lock in the cost of your existing property insurance for up to half a decade without swapping carriers or brokers. We're addressing this problem because it's new and it's urgent, and I saw it across billions of dollars of commercial real estate that I underwrote at Blackstone. Starting really in 2022, we saw dramatic increases in the cost of insuring real estate. The future became uncertain. We didn't know if premiums would increase 5% or 50% for the next decade. That uncertainty kills acquisitions for commercial real estate investors. It's an affordability headwind for homeowners. You know, we have these fixed mortgages, but no one told homeowners that insurance can double overnight. There are a bunch of ways to try to address the insurance crisis. You can try parametric, but in real estate, many lenders currently don't accept pure play parametric due to the basis risk. Some weather forecasting can help, but typically and some leading weather forecast models that are new tend to be less bullish on climate risks, and so premiums actually go up. You can try to harden assets, but operators usually just reject unnecessary CapEx that's not mandated by the lender. So we try to solve this problem by being pragmatic. We go after the timing issue. The core problem is that real estate owners commit to assets for half a decade or a decade. Insurers only commit for a single year. And so in the face of new climate risk, those two just collide to result in real pricing volatility for real estate owners. So the punchline is that for the first time in human history, real estate owners are demanding multi-year property insurance contracts. Next slide, please. So we enable exactly that with the premium lock, which bolts onto existing one-year insurance contracts, and it guarantees that the premium will not exceed a predetermined level that we predict. In a few clicks, this effectively converts a one-year policy into a multi-year policy, and it's carrier agnostic. Demand on the platform exceeds several $1 billion of commercial real estate and residential real estate looking to buy protection against this volatility. So now we're looking for our next capital partner to provide capacity to unlock our next stage of growth and to keep up with all of this demand. We manage a captive vehicle as counterparty to the guarantee for our customers. And for our capital partners, the cash flow stream looks a lot like any insurance-linked security or asset-backed debt facility. So you're generating positive cash flow day one. You have highly granular, diversified collateral across carriers, property types, geographies, policy forms. And we've contributed substantial subordinate cash equity from our corporate cash and from customer fees. That all blends to an attractive mid-teens IRR for multiple years for the capital partner. And lastly, we combine thoughtful distribution embedded everywhere that it makes sense, especially with lenders and agents. Behind the scenes, our product is powered by models built on some of the highest quality training data in existence, comprising 26 million US homes and 150,000 commercial properties with a decade of property and policy level data. We unlock those data with sharp doctorate brainpower in machine learning and climate, including our head of data science, who's the PhD from Kettle, and their machine learning work in wildfire ignition, spread, and insurance pricing, as well as some financial product design expertise with a recent hire from Citadel, the hedge fund. So wrapping this up, we reduce volatility in property insurance markets using differentiated data, a thoughtful approach to modeling, and a willingness to innovate. So with the right capital partner, we can build financial resilience against climate change for really anyone who owns real estate. So please reach out directly to learn more. Thank you.
Thank you, Dylan. Okay, to wrap us up on presentations today, we have last but not least Val AI.
I'm here to introduce you to a platform that empowers insurers and reinsurers to tackle climate risk, enhance engagement with customers at a retail level, and unlock new revenue, all through the lens of residential and home energy efficiency. Insurers, they do face increasing challenges. We've heard that today, with energy efficient homes being one of the most important when it comes to the cost for insurers, vulnerability of extreme weather, and often these homes becoming stranded assets, putting pressure on the insurer, reinsurer, but also the consumers who live within our own communities. Additionally, the lack of granular climate data, particularly when it comes to the inside novel data within houses and the growing ESG reporting requirements with mandatory disclosures, this places immense pressure on insurers to act really swiftly and decisively on determining who are the best consumers to be within their mortgage or residential portfolios. So Val.ai, we have a cutting-edge digital platform that uses real-time data, including aerial imagery analysis and advanced algorithms to assess and manage energy efficiency at a home level and the climate risks across residential properties within your portfolio. So this is how we deliver value. We provide data-driven insights, so instantly we can provide in an automated fashion analysis of the energy efficiency and climate risks of any property within your housing portfolio. We provide predictive analytics for the future energy costs and also what those risk exposures will be for yourself. We also, and more importantly, from this data, also provide digital engagement solutions for your household customers. This is for us to ensure that once you've been aware of and exposed to the risk, you can then take meaningful action to reduce that risk and track that over time. We use behavioural science-backed recommendations to incentivise your customers, those homeowners, to make energy efficiency upgrades, and we nudge climate action for you to show and build and continue to keep your customers sticky over time. We have clear, explainable data that helps build trust with consumers, regulators, and also stakeholders, all of which has been built with the support of Amazon's Innovation Advisory Services and 5 global banks. We have scalable risk management. Real-time portfolio insights let you as the insurer or a reinsurer manage millions of properties effectively, but also to drive action in the way in which you choose to take your portfolio into the future to drive down risk exposure. We proactively address high-risk homes to reduce claims and also ensure that you reduce the chance of stranded assets. Next slide, please. We have proven results. We've taken the Commonwealth Bank of Australia, for example, Australia's largest bank, and they've integrated Val.ai to trigger mortgage holders to take direct action, providing energy efficiency scores and apps within apps for their customers, improve their portfolio alignment through their sustainability goals and climate metrics, and also boosted their engagement through actionable homeowner insights that have triggered homeowners taking out more capital in order to deploy on homes and allowing the Commonwealth Bank of Australia to be able to actively track that for their task force for climate-related financial disclosures reporting. So why is Val.ai ready now? Well, we're ISO 27001 globally certified as a data holder. We also have ACCC access to open energy behavioural data. We've worked with Aon and IAG to test and train some of their own models when it comes to climate reporting. But more importantly, we've been partnered with Harvard's Behavioural STAR team, their science team, to ensure that our solution not only delivers insight, but it also triggers meaningful actions for your customers to take. The benefit of Val.ai is accurate risk pricing, tailored green insurance products, ESG compliance made effortlessly with data-backed reporting, enhanced customer loyalty through lower premiums, and incentives for energy efficiency upgrades to be taken, which you manage, and you can also be a part of the ROI of as well through your global supply chain. Within the future, we see Val.ai as someone who can be placed to help insurers lead change towards a more sustainable and resilient world. Together, we see that turning climate risk into an opportunity for growth, innovation, and long-term profitability for the insurance sector through our data-driven insight, and more importantly, our ability to track, manage, and nudge climate action at a household level. This is a really important approach for insurers, but more importantly, we've been backed by reinsurers who show and have demonstrated the need for the data on these actions being taken being more important than ever. Thank you.
Thank you so much. And just one more big thank you to all the presenters who joined today to talk about the great products and solutions you all are offering in this space. And a big thank you as well to everyone who joined. Again, we will be sending out the deck and contact information for all the presenters, and we encourage you to reach out directly to them. We'll also be posting this recording and the slides on the NYSERDA website. So thank you. I hope you all have a great rest of your day.
Thanks, everybody. Appreciate it.